Good morning, Angie.
Hi, John. How are you?
I'm good.
Fantastic. I've got so many different times right now. So I'm actually seeing the top of the hour on one of my clocks. So I'm not going to delay here. I wanted to welcome everybody. Good morning. Pretty sure I'm hitting all the time zones correctly, but wanted to welcome everybody we're in March. We're the last month of the first quarter. Welcome to my podcast, The Long Term, Angie's Advice for Agents. I'm Angie Hughes with Producers XL. And this month, our podcast, very excited to bring back with me John Thomas with Securian, because he's going to have some pretty exciting things to talk about with a new launch. So before we get into that, John, I wanted to make mention, I just got back from the ILTCI conference, which is really just a bunch of me and my peers and insurance companies, and we're all getting together. We always miss you when you're not there, John.
Yes, I was so disappointed I couldn't be there.
Well, the nerd bank held it down for you. I'll give you that much. I took in as absolutely as many sessions as I could, but this is going to be a great way to kick this off, because one session I went into and I was like, oh, what am I going to learn from this? But I always go in with an open mind, and it was chronic illness riders, LTC riders, hybrids, all of that stuff. And I have to tell you, I think we didn't have enough time to finish that entire session. That's always a good thing.
Yes.
But I tell you what, I think everybody walked out of that room with their mouth open a little bit, gasping for, oh my goodness. I want to share with you some statistics. And I don't want anyone to walk away from my podcast and say, yep, that LTC industry's dead, because it's changing. And this will launch right into what you're going to talk to us about today, John.
Yes.
Some interesting statistics from this. Back in the year 2000, there were 750,000 traditional long-term care policies sold. Fast forward 20 years. In 2020, 49,000 traditional long-term care policies sold.
Wow.
This is probably where everyone's kind of jumping off the bridge of, oh my gosh, traditional sales are dead. So there's a massive decline. Here's what was interesting. Moving over to the hybrids, the LTC riders, the chronic illness riders, which is really kind of where things get a little murky. In 2017, when we started tracking all of this, there were 260,000 policies sold. Jumping forward to 2020, 421,000 policies sold on some sort of a non-traditional long-term care solution.
Wow.
And it just gets more interesting from there.
Yeah.
So when you're looking at a pie chart in premium market by type, right? So we've got true LTC riders where we're accelerating the death benefit. That was about 15% of the premium market share. Then you move into linked benefits, which is going to be chronic illness riders, things of that nature.
Sure.
35% of the premium share, and then 50% of the premium market share fell into the chronic illness rider.
Wow.
Now, my last just jaw-dropping piece of information I brought back, and this is where I will be getting on a very big pedestal to shout this as loud as I can. I mean, I kind of hightailed it over to a booth about a CE course that they're looking to provide on the differences between the chronic illness, the long-term care, the hybrids. There's premium charging chronic illness riders. There's no premium charging chronic illness riders. A true LTC rider on a hybrid or linked benefit charges a premium. And then just to make it a little bit more confusing, you actually can have a chronic illness rider filed not as a 7702B, filed as a true chronic illness, but follows the NAIC rules as a 7702B. I mean,
As an
why
LTC
keep,
writer,
yeah,
yeah.
why keep any of this simple? This
Uh-huh.
is where I just was like, if you could see me sitting at my desk right now, my hands are over my head and I'm like
Uh-huh.
pulling my hair out. So when you break down chronic illness riders,
hmm
86% of sales are chronic illness riders that do not charge a premium.
Wow, really?
So this kind of like my heart hurts.
Yeah.
And for those listening to this podcast, I am not hating on chronic illness riders because all of you have probably spoken to me about them. There's a fit for everything. But when you start talking about a non-premium charging chronic illness rider,
hmm
you are foregoing any certification for long-term care training. And I'm sure that's probably the big push as to why these are being sold more often. But
Right.
you better understand how that chronic illness rider works at claim time. Because John, you and I both know, usually if there's no premium assessed to that, then it's
Yes.
a discount of the death benefit at time of claim.
At time of claim, absolutely. Yeah.
You have no idea. If you can't tell your client your policy is going to pay X per month for X benefit period,
hmm
that should stop and cause a little bit of pause. Again, I'm not telling you it's the worst thing in the world. It's not. It's a fit. Usually if it's non-premium paying, they're by default going to get that rider, which works for those people that can't qualify through underwriting.
hmm Right.
So John, I'm going to calm down a little bit. I'm going to take a breath and I'm going to say to you, thank you for being on my podcast.
Oh,
We
absolutely.
want to, and you and I both know we've done these in the past before. These are not usually big. I don't like to bring folks on and talk about product,
hmm
but you guys are launching. You launched.
We did. We launched yesterday our
I am
brand new
excited.
product.
Tell us what this is all about. Believe you me, I've already been out there. I've been firing quotes out left and right.
Oh,
Wanting
fantastic.
I know. Tell us what you guys have done.
Yeah, yeah. Well, Angie, if I may, I'm just, I'm kind of blown away, and so appreciate you starting the conversation off with that data from ILTCI. I had no idea it was 80% of chronic illness riders that are sold without a premium charge.
It
I mean,
hurts, doesn't it, John?
it
It
does,
hurts.
it does, and we're believers in long-term care and long-term care that matters at the time of claim, right? I mean, because that's what it boils down to.
What it's about.
That's what it's about, and with these discounted riders, you know, it's nice not to have the additional premium charge up front. But folks, I don't think folks really know what they're going to be getting at the end of the day.
Oh,
And that's what's concerning.
it
So
means
I,
we're not
I, I
selling.
feel your pain. I'm with you.
Yeah.
Yeah.
We're not selling long-term care. I mean, I don't want to be preachy about it. I mean, could I say that we've never really sold? We wait until, I mean, the research shows us that we sell long-term care when someone asks us for it. But
That's right. Yeah.
to take the route of a chronic illness rider that doesn't charge, super glad that Securian and the SecureCare III launch product is a premium charging long-term care solution. That's why you buy it.
That's right. Yes. Yeah, well, Angie, I'll give you a little bit of the holistic picture of the long-term care products and solutions that Securian offers. And so we have, as you know, we've been in the long-term care space for, it's been about a decade and a half now, if not a little bit longer. And we do have, or have had in the past, long-term care riders on our life insurance products. These are qualified long-term care. You accelerate the death benefit for long-term care. Over the last 4 or 5 years, we've kind of transitioned from that long-term care rider to a suite of several different options based on what best fits the client. And so we introduced SecureCare in 2017, and we decided to make SecureCare our flagship long-term care product. It's a qualified 7702 long-term care solution, and all the benefits of long-term care are available in SecureCare product. In addition to that, it is an indemnity product, so everything you're getting out of that benefit is cash. It's income to you. And when
Huge. That's huge, John.
that is, it absolutely is. And when we made that introduction to the market and joined this hybrid linked benefit market with the addition of SecureCare, we did transition our writers on our traditional life insurance to chronic illness. Because as you said, there really is, unfortunately, it's maybe not always what we would prefer, but there is a segment of folks that just are not going to go get the LTC certification, right? They're not going to take the time.
That's right.
And so, we decided to have solutions for everyone. Our long-term care writers for your producers that sell a little bit of life insurance, they're not going to go get the LTC certification. We can add that chronic illness rider. A majority of our sales, I'm happy to tell you, are a premium charge chronic illness. And so what you're getting up front, you're paying for the chronic illness at claim time. You're going to get the stated death benefit accelerated in the form of chronic illness long-term care. And so that was our position with our long-term care writers, and then we added SecureCare in 2017. Since 2017, we have really become a major player in this market, the asset-based market. And many of you on the call know those players as Lincoln Money Guard. They were the first to really frame this market, and Pacific Life and One America and Nationwide. And we're happy to report that we're in the top 4, flirting, I think, with 2 and 3 in terms of market share in this market. And so it's been a phenomenal run for us. And since 2017, we came into the market at a pretty advantageous time. We priced it based on some assumptions we had from 2015, and priced the product pretty well. And we're able to hold that pricing for the most part until today. Other carriers, were forced to reprice a few times, and so it put us in a pretty good position. And so, now we're at a point in time where, of course, those assumptions from 2015 have changed. COVID was a major factor over the last few years. Every insurance carrier has been hit. We've paid out over $1 billion in life insurance claims. Our assumptions about claims due to COVID results that we're starting to see and long COVID are affecting life insurance and long-term care. And then interest rates just have not come up in the way that we all expected them to over the last 5, 6, 7 years. And so it is time for an adjustment, but I'm happy to say that adjustment is built into the product in a way that still keeps a very competitive long-term care benefit. And so
I've ran the quotes.
Yes, well, awesome. I'm glad to hear that. Yeah, so you mentioned it. We've launched SecureCare III. And it really is our commitment to this market. We're doubling down. We believe in long-term care as a viable form of protection for elder care. And as a carrier, we want to participate in an even bigger way in this market. And so SecureCare III is launching with what we're calling Ltc Boost. And so LTC Boost is an option within the product to keep as much long-term care leverage as possible for your premium dollar, given what we can provide in today's pricing environment. And so that LTC Boost option for us gives just as much, for the most part, just as much benefit as our previous product, SecureCare UL, just as much benefit, if not a little bit more at some ages. And so we were able to give a little bit more benefit for some folks with that LTC Boost option.
I really think that's probably going to be the leading way that we illustrated. I know everybody kind of lives on the adage of the live, die, quit model. And John, I don't want to steal your thunder because I know you're going to go into this SecureCare UL versus now SecureCare III, which is not a UL, but
it is a whole life. Yes.
Yeah. So it still
Yeah,
has the story of live, die, quit, right? Because there's surrender values in there. But the LTC Boost allows you to actually maximize the long-term care benefit. And I think we're well, obviously based on these statistics from ILTC, we've lost sight of why people are buying life and long-term care combo products.
yes,
They should be
yes,
buying it for the long-term care. So what a great idea to boost those long-term care benefits. If you want to go buy something that's got great cash accumulation, big beefy death benefits in it, these aren't your types of solutions. None of these hybrids are
that's
your
right.
types of solutions. That's not what they're for.
Hmm.
They're really for the long-term care solution. So I think that's probably going to be the leading way that we illustrate these is with that big boost to give the biggest LTC benefit as possible.
Yes. Yeah, no, Angie, you're absolutely right. As we kind of reevaluated our chassis that we're using to deliver long-term care in SecureCare, we initially had a universal life chassis, and that was kind of based on what other carriers had done in the market. Universal life
Mhm,
chassis is what had been used. It was the initial chassis that Lincoln Money Guard used when they introduced this type of product
mhm,
several decades ago. But our experience over the last several years has been that a universal life chassis has both non-guaranteed and guaranteed values in the way that we built it. And this is not a non-guaranteed product. We sell it as a guaranteed solution. Everything from the premium death benefit that's stated in an illustration and long-term care benefits are all fully guaranteed. And so why have this non-guaranteed component that
mhm.
creates some confusion, particularly as you look at a policy and you're talking to your client, they may ask you, what are these non-guaranteed cash values? What is that for? Right. And so it actually added more confusion than certainty in I think the just the conversation with folks
Mhm,
on how these policies work. And so we
mhm.
decided, we don't need a universal life chassis. We can move to a whole life. This whole life chassis just shores up all of the guarantees. There's only one cash value. It's fully guaranteed as a guaranteed whole life. And so whether you're looking at an illustration or a policy contract, all of the values are consistent and make sense and will be a bit more clear.
Mhm.
Um, and as you said, this LTC Boost option, it is maximizing long-term care while giving up a guaranteed surrender value, essentially the return of premium. So a lot of these,
Mhm.
as you said, were live, quit, or die. If you quit, you have full liquidity. You can cancel it and get all your money back.
Mhm.
But really, as we found, and we're having conversations, and we've seen this as products have changed in the market, folks that understand the solution and the need are buying it for long-term care.
Right.
Uh, Very few folks cancel it. I think we've had nearly a 1% cancellation rate in our 5-year experience in the market so far. And so people buy these products, they hold on to them. They're really not buying it thinking that they need an exit plan down the road. And so the market has shown us that folks are willing to buy it and buy the most long-term care leverage and don't necessarily need that full liquidity or promise of return of premium should they cancel.
Right. And John, I will tell you, that's just not a Securian number, of the statistic of what 1% or so, actually walk away from their contract. It's either an LTC claim or death. That's actually
Mhm.
industry wide because I asked several of the other hybrid carriers, is that whole quit situation, is that, hey, I just want to walk away from this contract, give me my money back. How relevant is that in the space? And honestly,
Mhm.
like you said, it's because when people buy, I mean, why do we think in traditional long-term care insurance we have such a low lapse rate? People don't give up this coverage, and we're seeing folks taking massive rate increases on some of their blocks of business on that
Oh,
tradition.
sure.
They're still not surrendering those. They're not walking away from them.
That's
That
right.
still
Yeah.
holds true in that hybrid space. So, it's not that there's not a quit function. There's just
Mhm.
there's just no 100% return of premium function. I mean, if you want it, you can buy it,
Yes. Hmm.
but you're gonna, and I like to use the frame of you're gonna pay to play. I mean, if you want to
Right.
load that thing up and have that option, you can have that option, but you'll pay the premium charge for it.
That's correct, Angie. And I'll give you an example. We're going to a model with 3 surrender options or 3 return of premium options. The fully vested 5-year 100% return of premium option that we've had on our pre-existing product. So that will remain as an option. But then we're adding a 75% flat surrender return of premium option. And then the LTC Boost. The LTC Boost doesn't have a return of premium guarantee, but just the cash surrender value of that whole life product. And so to give you a sense of what that may look like, a couple of numbers. We have a 60-year-old in the the scenario that we often use to compare products, right, is a 6-year long-term care benefit, 3% compound on a 6-year-old female. If we look at our 100% vested, you cancel it after 5 years, you get all your money back. The benefit at her age 85, the 6-year-old benefit at age 85 is going to be just shy of $500,000. If I compare that to our 75% flat option, the LTC benefit at her age 85 is going to be about $580,000. And then the LTC Boost is going to get us about $615,000.
Wow.
Now, in the fully vested, you have 100% of your money back if you cancel it. The LTC Boost option on that 6-year-old, if she were to cancel it, she'd get back about $70,000. It's $70,200 at her age 85, or roughly around there if she were to cancel it. So it's, there is certainly a loss should she walk away, but the trade-off in the amount of long-term care benefit, it's roughly $120,000 of additional long-term care benefit. And the trade-off and what we surrender when we know the likelihood of surrender is so low, I think that trade-off makes a lot of sense.
Sure, absolutely. John, tell me this: if we're looking at some younger ages of folks going into these types of products, I kind of don't like to use the whole young professional doing well in life, but I mean, let's face it, hybrid policies aren't necessarily for the week of checkbook. But with that being said, you guys have some interesting pay modes as well that allow us to get into those younger ages.
We do, yeah. A couple of years ago, we enhanced the product a bit. It wanted to attract, I think what we all call in the market Henrys, right? Those high earners, not rich yet. I think is the acronym, right? So your folks in their early to mid 40s, early 50s that have significant income, but don't have the saved assets yet to do the big single pays or the big 5 pays. And so we added a 15-year pay to the policy a couple of years ago as one of our enhancements. And that 15 pay does make the product fairly attractive when you're talking about funding it from income. On a mid 40-year-old, you could fund a couple $100 a month and provide an attractive benefit. It may not be a large benefit to start, but when you add a 3% compound rider, and we're talking somebody that's, in their mid 40s and is going to grow for another 30 to 40 years, it creates a significant long-term care pool of money. And so for a couple $100 a month funded over 10 or 15 years, it'll be paid up by retirement. They're going to have a policy that compounds with either 3 or 5% compound and creates a huge LTC pool.
And John, what I think is really cool, and tell me this under your new launch, do you guys still have the option if somebody goes into a 15 pay and they want to stop short, not to use the Costanza reference, but I mean,
sure,
you can actually, I mean, you don't have to finish out that, right? The illustration will show you if you do stop short on that 15 pay.
That's right. Yeah, it is fully guaranteed from purchase, no matter what happens, even if you stop paying premium payments. And so contractually, and even in the illustration, when you first quote or look at a particular client, and the illustration shows you at any given year, should you stop making premium payments, what the guaranteed long-term care benefit would be. And it is somewhat proportionate. If we say, we have a 10-year payment schedule and you stop paying premium after 6 years, so you've paid in roughly 60% of the premium, the reduced benefit you have is going to be in the ballpark of 60% of your original benefit pool. And on top of that, if you stop paying that premium, the now reduced benefit that you have will continue to inflate. And so you don't lose any of that inflation potential either. And so that makes it a fairly attractive, I think, for folks, particularly if you have maybe a small business that a small business owner wants to fund it, but their income year over year can be a little uncertain.
Mm-hmm.
You can go ahead and buy it and say you're not completely locked in. If you go 5 years and have several bad years and can't keep up the premium payment, you can stop it. And at least you have, it may not be the full benefit that you anticipated, but you have something, right? And that something's going to continue to inflate. And you could potentially pick up another policy down the road.
Yep. And that's what I like about it. I often get asked, Angie, who's got the best long-term care solution? Well, that's just too much of a broad brush stroke. But what I do say is I can promise you the most flexible is always cash indemnity. And I think most of us on the podcast today realize that there's not a lot of cash indemnity contracts out there anymore, right? So,
Sure.
I mean, if we start thinking about these younger folks looking at planning for, things in the future, because they're experiencing it with their parents, their grandparents. I mean, we're all seeing this need of care. Then that flexibility could become really important later down the road if all of a sudden the way that we receive care isn't the way that they're rendering care today.
That's
So
right.
that's always a great selling point. Well, you guys got some really good things going on here with your new product launch. I definitely wanted to give you some time and some airspace to talk about it. Anything else kind of top of mind that you think sets you guys apart?
Yeah, absolutely, Angie. I'll mention just a couple of other additions with the product. We're always, and particularly I as a salesperson, I'm always talking to our actuaries and our product folks like, hey, we need to add this, we need we need to add that, right? And fortunately, they listened to us a little bit and did include a couple of additions in the product. Things that, particularly for folks that have sold traditional long-term care may appreciate. We have added a premium waiver rider for all states that, if you do have that 10 or 15 pay and something happens and you end up going on claim while still in that payment period, with that premium waiver rider, it waives the full premium. And so I know with some products, maybe a life portion or the long-term care portion of premium is waived. This will waive the entire premium while on claim, so you don't have to continue making those premium payments. And so that was a great addition. In addition to that, there was some flexibility in payment arrangements that was added. And our product initially had a somewhat rigid premium schedule, so that if you wanted to fund it over 5 years, you could only fund equal payments every year. That did make it a little challenging for rollovers or 1035s or someone that wanted to drop $50,000 in it and then fund a little bit over a period of time. So that kind of flexibility was added into the solution as well, so that you could drop a lump sum and then fund a little bit more over a period of time, or roll in $60,000 from your old whole life policy, and then fund a little bit over time. And so that flexibility is huge.
Yeah, I love that feature.
Yeah, we as we continue to be in this market, we continue to strive for simplicity and flexibility. And you hit the nail on the head. I think cash indemnity is a really a foundation of that simplicity and flexibility. I like to tell folks it's as close to income as you can get in these type of solutions.
Yeah.
When you file a claim and you start to receive benefit, you're going to get that income to use however you see fit. I tell folks often about my great aunt. She just celebrated her 100th birthday last year during COVID, and
That's awesome.
we had a small celebration with family. But for the last 7 years, my mom has been her care coordinator. And she did not have a long-term care policy, but fortunately her husband was in real estate and left her significant assets that she could use to fund her own care. But my mom's her care coordinator, and she employs everybody in her community. She uses an agency some that has and sends licensed healthcare folks to the house to help care for her. But both of my sisters, spend time with her and are employed providing care. Several ladies from her church, extended family members. I've got a niece that spends some time caring for her. So it's a community effort. And when you have something like cash in families where a lot of times that's the reality, right? Everybody chips in, everybody helps out. When you have a policy like cash, it can make that possible in a way that the policy helps pay whatever arrangement your family decides on.
And
So
John, isn't that so true? I mean, with or without insurance, the question really becomes, is it with or without income? Are we able to actually self-fund our own care? Vast majority of Americans, the answer to that is no.
right.
They don't have the resources and the income. And really, that's all long-term care is. It's a
Mhm.
source of income to pay for care when needed. Not a lot of us get the opportunity to exit this earth without needing some level of care for some period of time. That doesn't mean
Yes.
20 years in a nursing home. That doesn't mean dementia or Alzheimer's. It's just some level of care, because guess what? Every year you celebrate a birthday, I think we all get, a new, crink in the neck, or a new hitch in the giddy up, or,
Oh, yeah.
so recognizing that we do get older, and how are we going to pay for that care? That's what we need to talk about when it comes to long-term care, extended care planning, is how are you going to pay for that?
That's right. Yeah. And put yourself in the best position with the resources and assets that you have today,
Mhm.
right? I think we often uh, um, uh, look at investments as the answer, or focus solely on retirement planning. But this is a part of retirement planning. Because your aging years and years that you need care may make up a significant part of retirement. They
Mhm.
do for a lot of folks, and so it certainly needs to be a core part of the retirement planning conversation that we have.
Agreed. Couldn't agree more. John, anything else you want to add about SecureCare III?
Angie, I really appreciate the time. It's always a pleasure to come on and join your podcast. So thank you so much. For anyone that hasn't taken a look, please go out to our website,
Mhm.
or reach out to you, Angie. I know that you're very familiar with quoting and can provide quotes for folks. But SecureCare III with LTC Boost, I think you'll be pleasantly surprised
Mhm.
that despite all of the adjustments in the market and pricing changes in long-term care solutions, we really have kept, I think, the competitive edge and maximum LTC benefits that we can for folks. So I would
Most
just
certainly.
encourage everyone, if you're on the fence of taking a look at it, to absolutely reach out to Angie and give us a look.
Yeah, I mean, let me run you some quotes. If you're accustomed to showing another carrier as your hybrid solution, and you're like, hey, I just want to see what these guys look like. Let's just see what that, I mean, absolutely. I mean, my email's Angie@producersxl.com. Um, let me help you with that. And one shameless plug for you guys on Securian. If I'm not mistaken, you are also having a webinar tomorrow, not my podcast, a true webinar from Securian, talking. They'll probably do, I'm assuming, an hour, another deeper dive
Mhm.
into the product. So if you don't have the email invite, and you're wanting that, shoot me an email, give me a call, 800-541-6705. Let me get you that Securian if you want to attend that webinar. I think I've got it down for 1 o'clock Central tomorrow, but that'd be another great way to take a deep dive and see a little bit more about their product. But I would encourage all
That's
of
right.
you to do so. It's impressive. It's impressive. I've ran some numbers, and it looks real good. So John, again, thank you so much. Best
Thank
of
you,
luck on
Angie.
your launch. I know you're going to be very busy, so I appreciate the time that you've given me here today. And for the rest of you, we'll see you next month. Thank you very much.